Let's talk about why property taxes on a home, why property taxes increase after construction. So, this is very common and it is something that absolutely needs to be known if you're buying a newly constructed home. So, in Texas, the way Texas property taxes work is that taxes come due in October but they're not necessarily considered late until after January 31st. So taxes aren't due in December; they're due when they get posted, which is mid-October ish. So the reason why I say that is until they get posted mid-October, we, the lending community, title companies, lenders, realtors, builders, we don't know what the exact tax bill is going to be because taxes are a combination of the taxed value times or multiplied by the tax rate, which again, that's based on voting, and that's city, school, county, a bunch of other stuff that may go into it, like MUDs and PIDs and whatever. So all this to say that the actual exact amount due for taxes gets posted in October. So why is that important? When you buy a newly constructed home in Texas, the value, the assessed value for those property taxes calculations happens around that February to March time period. So there's a letter of or a notice of value that gets sent in the mail to where the homeowner at that time is notified of the value at that time period. So the February, March time period. So for example, on new construction, let's say a house just gets started in January, it's a piece of dirt. And so when it gets assessed from a value standpoint in February or early March, whenever that takes place, the value may be $50,000. Maybe it's $70,000. Maybe because it's just the dirt, right? It's just maybe there's a foundation laid, maybe there's not. But the valuation for taxes for that year is now based on this low number. So moving forward, right at the end of the year, when the taxes get posted in October, let's pretend at this point, this beautiful $500,000 home is now sitting on that property at the October time period when taxes post. It's based off the 50 grand assessment that came in February. So when somebody closes, let's say that house was done in June when they bought this house. It was found, it's a piece of dirt in January. By the time June's done, they got a 6 months in, they got a $500,000 beautiful home. And when they close, if it's not, if this conversation isn't had up front, let's pretend they worked with the lender, not Mortgage Mark, and they just did the values. They set up the tax values based on just the unimproved land, the $60,000 assessment. Well, if they go on and they have an escrow account that pays that amount based on this really low number, nothing happens at the end of the year because that tax or that escrow account is accurate. It paid and covered for that $50,000 to $70,000 home. Where people get in trouble then is in the following year. There's in February, March time period, well, probably March, April, but February to March, there's an assessment done of an escrow account. And the escrow account says, hey, we're good. And the reason why they say we're good is because the year before, the taxes were based off that $50,000, $60,000 evaluation. And then when the tax bill got paid, you're good. But because you're good, they've not changed the escrow payment. Now, if you don't have escrows, you choose to pay taxes on your own, separate from your mortgage, just know that the big bill is coming. But if you have an escrow account, your payments will stay the same. Well, now this next year, the next 12 months, that first full calendar year, right? You buy the home in this example in June. And so the next year in February, March, the value gets assessed at this $500,000 because it's that home, the home's on it. So now they're like, hey, it's 500 grand, but they still collect at the lower amount. So come October, that you lived in the home a full year, you get the tax bill that says, hey, it's posted. All of a sudden now it's this big dollar amount. But what happens is because you have an escrow account, your mortgage company or your mortgage servicer, they'll write the check for the big tax bill. But what's going to happen is it's wildly short because, again, the valuation, yes, this year's based off 500,000 for the actual tax calculation, but the escrow account collected, that's still based on the original $50,000, $60,000 from over a year ago. So what happens is the mortgage servicer will cover the shortage the following year So it's been a long time at this point. So a year and a half later, year and 8 months in this scenario, close in June, and it won't be until February of the following year. So what is that? 20 months later, February the following year, and they do an assessment of the escrows and they do an escrow analysis. They're going to say, "Whoa, we got a problem. We got a big old shortage." So what they then do is reach out to the homeowner and say, "Hey, guess what? Last year, instead of your tax bill being $2,000 like it was the first year when you owned it, it's now $10,000, and you owe us 8 grand." And so either you got to write a check for 8 grand and then your payments jump up, or they're going to set up a payment plan for you for 12 months and say, "Hey, you're going to pay that 10 grand now, in addition to the higher, monthly nut that you got to cover for the mortgage payment." And so now there's an extra $833 added on top of your already increased piece. So it's a real problem if you're not expecting it. So the Mortgage Mark team, what we recommend and what we do is at closing, we set up an escrow account based on the really big value. And that way, when that valuation comes in, initially that first time low. So if I close in June, we set it up on this big number. So at the end of the year, when the taxes get posted, that tax bill by absolutely the escrow account has plenty of money to pay the tax bill. Then when an analysis is done in that February or March, they actually return the excess cash to you, the homeowner. So that's how we do it. Now, the downfall of the way we do it is it does mean more money's due at closing because we're setting up a bigger escrow account. But it's, I think, the right way to do it because then you get your money back in February or March of the following year when the analysis is done, when the escrow analysis is done, and that money comes back to you. And I think that's absolutely the right way to go. It stinks at closing, but it's great then because then that following year, the next year, your payments are already set up to where it covers that big amount or that big valuation. So that's what we recommend. So if you know somebody that has this, man, I hate that they didn't get proper education or they don't remember maybe what that process is, but this is certainly something to talk about. If you guys need us or if you have any questions, absolutely reach out to us. But when you buy new construction and you have an escrow account, absolutely pay attention to this. If you don't have an escrow account, just know the big tax bills come in the following year. But it's not quite as dire just because you're making the checks yourself. So be expecting that increase. And if you have any questions, reach out to the Mortgage Mark team. And as always, when you think mortgage, think Mark.